It is 2 o'clock and we will get started with today's webinar. I'd like to welcome everyone to Specialized Loans, Youth Loans, Microloans, and Fractionated Land Loan programs. This webinar is part of our credit and FSA program webinar series that includes sessions focused on a variety of Farm Service Agency program topics, including business planning, credit repair, financial and marketing risks, youth loans, microloans, and fractionated land loans, and understanding your rights of appeal. If you look at the handout section of your control panel, you'll see a flyer that contains all the information you'll need to join any remaining trainings in this series. You'll also find the slideshow being presented today that you can download and keep for later reference. I also invite you to visit our website at indigenousfoodandag.com, where you'll find more information about this series and downloadable copies of the presentations. We will also post and archive videos of each webinar to our webpage. All attendees will be muted during the presentations. Attendees should use the control panel to raise their hands, or you can also submit questions using the questions dialog box. We have 2 presenters today, and each presenter will answer questions at the end of their presentation. This series is possible with support from the USDA Farm Service Agency and the University of Arkansas School of Law Indigenous Food and Agriculture Initiative, who have joined to offer this important series of webinar trainings. I'd like to introduce today's presenters: Dr. H.L. Goodwin, the Senior Economist at the Indigenous Food and Agriculture Initiative, and Janie Simms Hipp, the Director of the Indigenous Food and Agriculture Initiative. Dr. Goodwin is a professor and poultry economist at the University of Arkansas in Fayetteville, senior economist at the Indigenous Food and Agriculture Initiative, and director of student networking and curriculum enhancement for Bumpers College. He joined the faculty of the University of Arkansas's Center of Excellence for Poultry Science and Agricultural Economics and Agribusiness in December 1997. Prior to joining the university, he was the Agricultural and Food Systems Policy Advisor to the Minister of Agriculture in Slovakia and a Fulbright Scholar in Czechoslovakia. He was faculty at Texas A&M's Department of Agricultural Economics and served as the Associate Director of the Texas Agriculture Market Research Center. He received his PhD in Agricultural Economics from Oklahoma State University in 1982. Our second presenter, Janie Simms Hipp, is a Chickasaw Nation citizen and founding director of the Indigenous Food and Agriculture Initiative. She has been a licensed attorney in Oklahoma for more than 30 years and specializes in food and agricultural law and Indian law. Prior to launching the initiative, she served in the Obama administration as the senior advisor for tribal relations to Secretary of Agriculture Tom Vilsack, and prior to her appointment within the office of the secretary, she served in the USDA's National Institute of Food and Agriculture as the national program leader for Farm Financial Management Education, Trade Adjustment Assistance, and the Beginning Farmer and Rancher Development Program. She also served as the USDA Risk Management Agency as the Risk Management Education Director. We will now start our first presentation of the day. HL, take it away.
Thank you, Brian. This is the 4th in our series, as Brian mentioned, and I always look forward to these because it seems like they bring perfect weather. We have a fantastic day out here. So what I'm going to do is just step right in here. We've got a lot of material to cover. Some of it may appear to be a little tedious. I would urge you to focus on just the concepts, and as Brian has mentioned, this will all be archived and you can refer back to it as we move along. So Brian, let's go ahead and get started. I decided to go ahead and include in our presentation, talk about a beginning farmer. Beginning Farmer is also another loan program, and we have on here some definitional materials about what describes a beginning farmer. And notice it's anybody that's farmed, has not operated a farm for more than 10 years. They meet the loan eligibility requirements of being eligible for an FSA loan. And they're a substantial participant in the farming operation. Notice that there are two different types of loans for beginning farmers. There are farm operation loans and there are farm ownership loans. And there are some specific requirements there in point 4 about how you qualify for farm ownership purposes. The key thing is that it's not 30% larger than the average size farm in the county at the time of application. So let's move to the next slide. What are the maximum loan amounts? You see there direct farm ownership loans and direct operating loans have a maximum of $300,000. Microloans, which we'll get to in a little bit further into my presentation, has a $50,000 cap. And then a guaranteed combination farm ownership operating loan, approximately $1.4 million. I would add that here on the microloans that there are special eligibility benefits for young and beginning farmers and for historically underserved audiences. Okay, Brian. There's a down payment program here that's involved. The requirements are there in front of you, but essentially you have to make a cash down payment of 5% of the purchase price if you're into an ownership loan. The maximum loan amount cannot exceed 45% of either the purchase price of the land, the appraised value of the farm, or 2/3, $667,000. So that's where you get the maximum of $300,000. It's a 20-year term and it's a 4% interest rate. Excuse me. It can be lower. Well, I'm sorry. It's 4% below the direct farm ownership rate, but it cannot be lower than 1.5%. The remaining balance you have to get from a commercial lender or a private party. And so what's important to know, it's a co-lending program. An FSA can provide 95% guarantee. In other words, all the money that is borrowed can be guaranteed by Farm Service Agency if you're getting it from a commercial lender. And these lenders don't have to pay a guarantee fee. You have to have a 30% amortization period, and there can't be any balloon payments. You know, oftentimes loans will say you pay so much per year with a balloon at year 15. The requirements of this loan program specify that you can't have a balloon payment sooner than 20 years into the loan. So this joint financing arrangement, FSA will lend up to 50% and the other lender provides 50%. That's sort of what we just delineated. That's 50% of the amount that has to be financed. So obviously if you paid 20% down, you'd be financing 80% of the purchase price or of the loan amount, and then half of that could come from each source. Excuse me. The interest rate is 2% less than direct farm ownership if you use this joint financing arrangement, but can't be less than 2.5%. And the term of the loan can't exceed 40 years or the useful life of the security that you're giving in support of the financing. Then there are land contract guarantees that can be used. And this is to, again, financial guarantees to the seller of a farm through a land contract. All these provisions and these protections are to encourage, or let me rephrase that, to break down certain barriers to entry for beginning farmers or underserved farmers. What we often have is restriction on the availability even to have land to operate on. So that's what these protections are for. Excuse me. So this prompt payment guarantee is a guarantee up to the amount of 3 amortized annual installments. plus the cost of real estate taxes, and the standard guarantee is 90% of the outstanding principal balance under the land contract. Purchase price can't exceed the lesser of either $500,000 of the market value of the property. So it's another way to offer some guarantees. In this, the buyer again has to have a 5% minimum down payment. The interest rate is fixed. As you can see there, the guaranteed period is 10 years for either plan, regardless of the terms of the land contract. And they must be amortized over 20 years, and the balloon prohibition is at 10 years. So it's, again, a different way to look at young and beginning farmers getting into land ownership. Now this is sort of an interesting provision. A Farm Service Agency advertises inventory property. In other words, properties that they have control of. And within 15 days of when they take over a note and reacquire control of property as the lender, they have to advertise that this property is available. So the interesting part here is eligible, underserved, and beginning farmers have the first priority to purchase these properties at appraised value. So that sort of gives the first shot at these two special classes of farmers. And if one or more has an offer, then the buyer is chosen randomly. They essentially flip a coin or draw straws. You can apply at your local FSA offices. You can find that in the telephone directory. It's listed in various ways. Guaranteed loan applicants have to apply to a commercial lender that participates in the guaranteed loan program. So if you go to a lender that's not a participant in a guaranteed loan program, you cannot have a guaranteed loan. And so you can get that list from your local Farm Service Agency office. So let's talk a little bit about microloans. Farm Service Agency developed this because it realizes that there are sort of some unique needs for niche, new and small farms and medium-sized family farms. So what these microloans do is offer a lot more flexibility to services. Specialty crop producers, operators of community-supported agriculture, and these smaller non-traditional farms a lot of times have limits as to what will be financed. It's viewed as a little more risky than usual. And so FSA came up with a microloan program. There are operating microloans that are available, and you see the things they can include there. Some of these I have bolded because they're particularly often questions. Initial startup expenses, annual expenses. There's a listing of annual expenses there. Interestingly, family living expenses. A lot of times families put themselves in peril when they're in a startup situation, so they allow for family living expenses, purchase of livestock equipment, anything essential to the farm operation, minor improvements, wells, coolers, hoop houses, essential tools, anything that would help a small or niche producer to get into business. There are also ownership microloans. You might think, what can you buy for $50,000? If someone wanted to start a small berry operation, you can buy some pretty good property there. Within that, you can enlarge an existing farm if there's an opportunity to get 20 acres adjacent to you that you want to expand, if there's some new kind of equipment building or whatever that you need to expand. And also, and very importantly, pay closing costs and implement NRCS type of programs. A lot of times people are reluctant to participate in NRCS, EQIP, other kinds of programs, cost share, because they don't have the cash to get into that. So you can actually get microloans to pay for the part that would be cost shared. There's a streamlined and simplified application process. And very importantly, though, you have to have managerial expenses, and but these things have been modified so as to allow for veterans, small farm operators, beginning farmers to get into this program. Small business experience with apprenticeships also works, as does veteran service, and it's meant to assist applicants with limited farming skills to get in and gain farm management experience while they work with a mentor. So again, another way to help new entrants into agriculture ease into the process. There are some microloan applicant requirements. While that's on the screen, let me just say, and you can read that for yourself, but let me say that FSA has released that they are simplifying and streamlining their entire application process. And currently there are 9 different forms that must be filled out for loan applications or program participation with Farm Service Agency. It sounds onerous. Really, if you keep your records and you're willing to do some paper trails and paper management, which you should be willing to do anyway if you're going to succeed, it's not that bad, but it would be a lot simpler for people, particularly that aren't used to farm management experience, to be able to have a streamlined process. We don't exactly know what this is yet. The information, to my knowledge, hasn't been released, or at least I haven't seen it. I do want to point out significant business management is defined there. You see those 2 check marks, 1 year of management in a non-ag related field where you actually have serious management responsibilities, or military leadership or management. So those again are meant to encourage new entrants into the agricultural area. You have to have security. Operating microloans have to be secured either with a first lien or with 100% of the microloan amount. Operating loans made for anything other than annual operating expenses have to be secured by a first lien and have this 100% value of microloan. And ownership microloans are secured by the real estate being purchased, which makes a lot of sense. So if you want to, you can choose whatever you want to for security. It can be equipment, it can be buildings, it can be land, it can be stock or some other fungible resource, but it has to be secured at least 100% for operating microloans. There are your rates and terms. Again, the cap is $50,000. You cannot exceed a 7-year repayment plan. Annual loans obviously are repaid within a year, and typically when things are bought or sold. They use FSA loan rates and terms, and if you're in an ownership loan, again, you can't exceed 25 years, but it would be difficult for me to envision getting a $50,000 loan with a 25-year repayment period. You probably have other problems if you choose that long a period. So they try to make it where there are not as many barriers to entry, once again, as there are in commercial agriculture. You can get your loan applications either online or go to your local FSA office, and you can find a list of your local FSA offices if you don't know where yours is by going to offices.usda.gov, and they'll help you with the forms and the paperwork. Probably by, I would suppose by March, maybe the new application requirements will be released, but who knows? Now, it's very interesting. They have a process in place with these microloans that is sort of a step-by-step. You're given written notification of where you are. And I think this is, again, a way to help usher a new entrant through the process. So if you get denied for any reason, there are specific ways that you can appeal. I believe this either has been covered, excuse me, in the, it has been mentioned previously, but it will be covered in the 5th of our 5 FSA webinar series presentations. Again, eligibility requirements, the same family size farm requirement. You have to have a good credit record. You know, some people come in and say, wow, I couldn't get funded. There's some kind of problem. Why wouldn't FSA fund me? Maybe your credit record is not good. You don't have a good record of meeting credit obligations. That is important. It's just like anything else. Also, it helps if it doesn't help. It's a requirement that you can't obtain credit elsewhere at a reasonable rate and term. So again, the highly specialized niche kind of operations that typically aren't financed by commercial banks would be supported here by this FSA microloan program. Youth loans, this is the third thing I'll talk about. This is a very exciting thing. To me, I think it's the most exciting program that Farm Service Agency offers, simply because I came up as a farm boy in FFA, and I had individual loans that, you know, in the olden days, banks were small enough and everybody knew the banker and each other, and you could get loans. Now it's not so simple. We have regulations that prohibit that. So what FSA did was come up with this. You can get up to $5,000 to eligible youths ages 10 to 20 to start into agriculture. The definitions there, you have to be participating in an educational or, you know, and have a project that's ongoing or developed and carried out by a 4-H club, an FFA club, or something similar. They don't want to just support someone that's not in a mentored situation. You have to have an organized project with a permission of and oversight of an advisor, and the activity has to make enough money to repay the loan and teach you practical business skills. Here's the qualifications. You have to comply with FSA's general eligibility requirements, and again, conduct a modest income producing project in a supervised program of work. So again, that's the reason we're under these youth programs with mentorship. I do know a couple of youths personally that have had programs that have been supervised by grandparents or parents that are current operators. So this is also up to the purview of the folks assessing the loan applications. Okay, Brian. Here's what they can be used for. Anything that would start an income producing activity. Livestock, seed, equipment, supplies, tools, you know, anything, paying feed that's necessary, so fertilizer, whatever to get this project going are all allowable expenses. Just some more details here. Notice the applicant must submit completed plans and budgets signed by the project advisor and parent or guardian. And they also have to submit the FSA application just like anyone else applying for loans. $5,000 principal balance maximum. periodic interest rates. It has to be secured along with promissory notes by liens, and there must be a repayment schedule. Again, trying to get young producers to be business savvy and responsible in their financial operations. Okay, Brian. I'm available for any questions. Brian, if anything came in, I'd be happy to respond to that, or I can respond later. I know Janie has a highly fractionated land segment, so I don't want to drag this out, but if there are questions, I'll be happy to respond.
All right, thank you, HL. I'll just remind everyone in the audience that if you would like to ask a question, you can use your control panel to raise your hand, at which point I will unmute you so that you can ask your question, or you can type a question into the dialog box and I'll read the question out loud and our presenters will answer the question. We did have a question that came in and I'll go ahead and read it. We are in an area of higher salaries. In the beginning farm program, does the income in the projection have to be higher than the salaries of the applicants? That's the first part of the question.
Could you read that again, Brian? I want to make sure I get this correct before I respond.
Okay. In the beginning farm program, does the income in the projection have to be higher than the salaries of the applicants?
I would assume that would only be considered if the person was stopping their off-farm employment to pursue their operation. In other words, you know, that income has to be accounted for. So hopefully my response makes sense. I mean, if there was for instance, a married couple, and one of them needed to quit their job to start, and they forfeited a $50,000 income, obviously that would need to be replaced and accounted for, or you wouldn't be a good credit risk unless the other spouse made a lot of money.
Janie is speaking here. HL, I'm going to interject here,
Sure.
if you can hear me.
Yeah.
The other thing, and you may have covered it better than I am right now, but it just seems to me that whenever you're going in for a loan at FSA or anywhere else for that matter, is that anything that and it kind of goes to the heart of this question. They appear to be in an area where higher salaries are predominant, and they're starting to think that maybe their salaries that are indicated are going to be looking out of whack, you know, with applicants. I just think it behooves anyone who is going in for any sort of loan to have. Don't assume that you're going to walk in and get no questions as to every single one of your numbers. And so having a rationale and an explanation, and I would suggest that even having some proof that salaries are higher in your area might be a good thing to just have in your file with you when you go in to actually talk through with your loan officer what the loan application says, and just being able to give as much detail as you possibly can in your explanation.
That's good. For the best defense is a good offense. That's a good tip.
Yeah, you might never have to use it, but it's better to have it than to have a question asked and not have an answer. So there's another part to this question too. Brian's going to read it.
Yeah, the second part of the question is there a definition of a farm based on number of cows or number of acres cropped? It would not be in the applicant's best interest to quit their day jobs.
Actually, there are classifications of farms, but Janie, I believe any operation that has more than $1,000 in sales is considered a farm. Is that correct or not?
That's correct. So it's not tied to number of cows or number of acres. And then back to the points you were making earlier about your business plan, you know, that's where you really need to get in the weeds and make sure that your numbers that you're putting forward in your business plan that substantiates your application for a loan are grounded, you know, in a good reality.
All right, thank you. We have another question that came in, and this question is, I have land that has been declared as wetland. We have taken timber off the land and want to replant trees. What are the restrictions on wetlands, and where can I find out about farming opportunities?
Let me answer the second question first. Your local NRCS office or your county NRCS office should be able to respond to that. There are many wetland programs and conservation programs, but Janie, this is probably, I don't want to just pass the baton, but it's probably more in your wheelhouse of expertise.
Yeah, it sort of is, but we've dealt with this a lot over the years, HL. I mean, it's very important anytime you're clearing an area that hasn't been cleared before that you check with, I would check with NRCS, but I would also check, you also need to check with your state and local laws. In some cases, you may live in a jurisdiction that has some very specific restrictions on clearing areas that have already been declared a wetland. And so that can get you into some very ugly legal issues if you've cleared it without a proper permit. And so and that is a whole nother subject matter for a whole nother set of trainings. But it is very important to be very diligent as you go about to clear timber, or even if you want to replant trees, you might inadvertently walk yourself into a problem if you don't check out what the restrictions are on that, either at the federal or state or local level. And in some cases, state and local have even more specific restrictions than the federal would. So that's not really a good answer because I'm not sure where you are. But if you all, I mean, we have our emails and our telephone numbers are readily available publicly. If you want to just give us a holler, then we can walk through some more specifics about that answer. It's kind of difficult to go into without having a whole nother session, but we're happy to do that. Just give us an email or give us a holler after this webinar, and we'll walk you through some resources that are available to really kind of talk through wetlands issues.
And one other thing I just want to bring up, since we've sort of opened the door here, and I'll use myself as an example. I have some acreage, and it is in the Illinois River watershed, which is a protected waterway. And we have a conservation reserve enhancement program, which was passed and designated such that you can actually receive by having a long-term lease of that property and planting trees and doing other environmental protection activities, you can actually have cost share and have a small return by improving that. But that's under a special case, but there are all kinds of special programs involved for watershed protection, for wildlife enhancement, and other things.
The other thing I'll add to HL is that as you're becoming a beginning farmer, as you're getting started, it's really important not to just think about your lending situation or access to credit, but to also spend some time getting to know your Natural Resource Conservation Service officials, because they have tons of resources in all sorts of areas that are going to help you, in multitudes of ways around conservation of resources, the land, water, habitats, all over the place. So I just really encourage you. It's not enough to just think about the business plan. You've got to also think about the resources that can be there to help you from NRCS, which is a sister agency to FSA.
All right, we have another question that came in. This question is, how favorably would 25 plus years of small business ownership look with no previous formal farming experience in regard to receiving loans?
Well, depending on what type of loan you were applying for, obviously if you would be a beginning farmer, And that I would suspect would be looked at favorably because you show expertise of being able to manage a business. So that would just be my answer off the top of my head. But having said that, it would come back to what is your business plan? What can you cash flow your loan? Can you make your payments back? How sound is your strategy?
Well, and the other thing too, HL, is sometimes small businesses have a lot of bridge kind of applicability in an agriculture and food production arena. Maybe they're a small business that was a grocery store. I don't know. I'm
Right.
or a retail food environment of some kind. So those types of experiences and kind of peripheral knowledge of the agricultural sector could weigh more heavily than if you had a small business that was, say, a car wash. You very much need to be thinking about, as you're putting together your business plan for accessing credit for as a beginning farmer, what you're doing to up your game. What are you doing to actually, are you going to classes? Are you, and I don't mean formal university classes, but are you going to classes that you're, you know, for instance, the Sustainable Ag Working Group is convening right now. Got about 1,500 people down there. And those, I mean, how many times have you actually availed yourself of that kind of professional development? And I think those kinds of formal farming experiences that you can pepper your resume with, so that you're not just walking in with just a blank slate in agriculture, is going to help loan officers understand that you are a better credit risk.
All right, thank you. Before we move on to the next section of our presentation, I just wanted to remind everyone our website is listed on the screen right now, indigenousfoodandag.com/FSA. If you go to that web page, you'll see this presentation and past presentations, and I would just like to remind everyone, we've had some discussion about credit and credit worthiness. We did a webinar specifically about this, and if you go to that web page, you will be able to watch a video about that webinar. With that, Janie is here, and she will lead us into the next part of the presentation.
Thanks, HL. So I'm going to take over and run it from here. I'm very specifically talking about, in this next portion of the webinar, some very specific programs that Farm Service Agency has that are very specific to tribal land ownership. And both of them have been around for several farm bills, which means they've been around for a while, with appropriated and authorized funds attached to them. They haven't been as highly utilized as some might think that they could be. And you'll see what I mean by that when I get into it a little bit further. But one of the things that's happening in Indian country right now is a lot of attention to land consolidation and really clearing title to land and really getting land into a more usable state. And so what we want to do is kind of share with you just briefly what these specialized land ownership loan programs are for tribes, tribal landowners, and tribal producers. I have thrown, this is my MO, I throw a lot of slides at people so that they can go to a resource and have a lot of information. But some of these slides, particularly on the highly fractionated Indian Land Loan Program, I'm not going to spend a lot of time talking on because they only apply to a relender. And I'll get that information in front of you in a couple of slides. So let's get rolling. The two programs I'm going to talk briefly about today. The first one is the Indian Tribal Land Acquisition Loan Program. This program helps tribes become owners of additional property within their reservation boundaries. The purpose of these loans is to advance and increase current agricultural operations that are already in place, to increase ag productivity, and to save farmland for future generations. The loan program is financed and serviced by the Farm Service Agency. And what that means for you is if you're a tribal government and you are thinking about acquiring a loan from FSA to basically go out and acquire land within your reservation boundaries, you would be the borrower and you would go directly, it's a direct loan from the federal government, USDA Farm Service Agency to you. Funding comes for this program from congressional appropriations as part of the USDA budget. So that's an annual situation that has to go through the normal appropriations process. And as one can well imagine, that may change year to year. So it's always good to just keep in your mind that this loan program exists, but in some years there may not be appropriations attached to it. That is within the purview of Congress. USDA itself has no ability to infuse funds into the program if Congress does not appropriate it. So that doesn't mean it's not authorized. It still is authorized. It's been authorized for quite some time, but it does depend on the lending ability of USDA's Farm Service Agency depends on these congressional appropriations that occur from time to time. So just keep that in mind. Sometimes folks will go in to an FSA office and they'll say, well, I want to apply for this, that, or the other loan. And the FSA loan officer may say, we don't have any money for that loan. And you kind of scratch your head because why not? But at the end of the day, their ability to loan money depends on Congress continuing to appropriate funds for them to then turn and lend out. So just keep that in mind. To be eligible or authorized to apply for the loan, the tribe has to be recognized by the Secretary of the Interior. It can also be a tribal corporation established under the Indian Reorganization Act, or it can be a community in Alaska incorporated under the Indian Reorganization Act. It's authorized to be used. The loan proceeds can be used to mortgage, but that mortgage capacity has to be reflected in the constitution of the tribe, bylaws of the particular tribe, charter of the tribe, a tribal referendum, tribal resolution. Has to be some indication that the tribe is willing and legally able to grant a mortgage to USDA Farm Service Agency. When the tribe goes in, income has to be identified for repayment. And that can come from a variety of different sources. And so those really are truly going to differ tribe by tribe, loan by loan. And so you've just got to establish that relationship with your state FSA office if the tribe is seriously considering this as a potential loan, and just work through the loan application process and literally get into the weeds of what income is going to be identified for repayment. It could come from the land itself, or it might be an assignment of payment from other income. So that literally is going to differ situation by situation. You've also got to identify the current land use of the land that you're seeking to put into this loan program. And so it could be grazing, farming, forest lands, and it could be lands used for other purposes. Again, that's going to differ situation by situation, but it is a fairly broad capacity to acquire land for many different land use purposes. This slide has two links. One of them is to the primary form that deals with the land acquisition program that I just went through. And then the second link is to the instructions for filling out that form. It's not a terribly lengthy form to fill out, and it's not that difficult. And so I did not put a whole lot of specifics about the loan forms themselves into this particular webinar. I'm going to move right now to discussing the highly fractionated Indian Land Loan Program. Can you back up? But those loan forms are not identified on the Farm Service Agency website. and those will be emerging in the future, and you'll see why. There's a little bit of history of how the highly fractionated land loan program came to be, and kind of how it is in its current state, which I'm very excited about, and I'll get into that right now. The highly fractionated Indian land loan program, it helps tribes, tribal entities, and tribal members. And if you'll think back to the previous one I talked about, that really helps tribes acquire land. This one goes into individual tribal members. It can also be used to deal with land consolidation concerns and the desires that a lot of folks have to consolidate lands so that they can be used more effectively for ag purposes. It can be used for current and new agricultural operations that can improve and expand access to USDA programs. It can be used to increase ag productivity, and also, just as in the previous loan program, used to save tribal farmland for future generations. The loan program is financed through revolving loan funds from the Farm Service Agency, and it's serviced through an approved intermediary lender. And I'm going to refer to them as a relender. As of December 2016, this past month, the USDA selected the Native American Community Development Corporation Financial Services as the first intermediary relender that is authorized to relend for purposes of this highly fractionated Indian land loan program. So that's a very new announcement, and there's a history behind how we got here. I'm not going to give you I'm not going to turn this webinar into a history of fractionation of Indian land. Most folks who are listening to this have a personal experience in this circumstance. All tribes have lots of experience in these situations. The end result is that while there has been a deep historic situation tied to the result that we've seen now in our present day of highly fractionated land, there is a whole body of information in that. If you're new to the issue, I'll say most of the folks who live and farm or ranch in Indian country are extremely knowledgeable of this situation. And so I just threw this particular slide in to really remind us all how we got here. There's some fantastic resources on highly fractionated land issues and how to address these issues by our friends at Indian Land Tenure Foundation. I've given you just a sense of how fractionated the lands can be by the slide there on your right, that really can see how deeply our lands can be divided over time and really rendering them almost unusable for agricultural purposes, just because the ability to actually make decisions with regard to the land itself becomes so fractured. But for those of you, again, who are new to the issue, for those of you who are not new to the issue, you know that Indian Land Tenure Foundation and some other organizations in Indian country have some great resources out there to talk you through this issue. It's not a new issue. For those of you brand new to this issue, I would suggest that you start there and really kind of fan out your work from there. There's also organizations that deal one-on-one with the issues of allottees who suffer from these same situations in the Indian Land Working Group. So there's several organizations out there who can help you walk through these situations. The purpose of the highly fractionated Indian Land Loan Program in its current state is to work through these intermediary lenders, the first of which was identified back in December. But when the original law was passed, it really was quite vexing to deal with it. And anyone who's on the Farm Service Agency side of the house who might be listening in on this conversation, we had many conversations inside the USDA about how troublesome the law as it was originally written was in terms of our ability at USDA to actually roll out loans for this program. It was just almost impossible. And so what we did, and I say we because I was in the Office of Tribal Relations when we actually partnered with the Farm Service Agency to do tribal consultations beginning in 2009, I think. But we had several regional sessions to really talk through this program. It had not been fully implemented yet because of the way it had originally been written by Congress. It was just almost impossible. And so we really went through a very contemplative, a long period of study and a long period of consulting with individual tribes and individual tribal members about how best to actually roll this program out. Because it has had annual appropriations of around $10 million. So we were not really interested in leaving that money on the sidelines when it could be used in Indian country for land consolidation issues. And so we received a lot of recommendations on actually how to best refine this program so that it could be used. What ended up happening is that we had an overwhelming response when we went out to Indian country in these consultation sessions that to an individual, it was strongly recommended that Farm Service Agencies seek an amendment to the language in the next Farm Bill roll around, and then actually have new rules that would allow the appropriated dollars to literally be sent to relenders, and they will select the relenders from time to time, but that the actual administration of the program and what I mean by that is the actual loans between the individual borrower would occur between you and the relender, not you and Washington, D.C. Farm Service Agency. And so it just makes it more accessible and closer to the ground. But it also, for the relenders' purposes, it allows them to really do a better job of working alongside their borrowers to really get the paperwork's in order and really make sure that the loan's purposes are met. And so all in all, we received, that's the only comments we did receive, was turn this into a relending program, which FSA did. And so that has occurred. It took a while for that to happen. And I can't tell you how excited I am that they have actually selected their first relender and are moving into this new way to deal with this particular highly fractionated Indian land loan program. It's going to open up that continued appropriation, provided we still have it from Congress, which we need, to continually put these kinds of resources out in Indian country to basically, in some cases, what we were looking at in some regions of the country was individual borrowers that really didn't need anything more than $5,000 or $10,000 to buy somebody's interest out and consolidate the land. And so it just putting it into a different context makes it easier on the borrower. So this slide goes back into that circumstance and how we kind of got there, how we got to this decision to do consultation, what the consultation input was, and I'll just leave that to you to take a look at later. We did want to put it out there to you so you could see the history of how we got here. So the purpose of the new program, which resulted from all that consultation and a subsequent change in the Farm Bill language, which allows FSA to really manage this program in a better way, really specifically the next step for them when they got those changes was to literally put the money out through a request for applications for intermediary relenders. And so that has been the subject of quite a bit of their attention over the last several years, is to make sure that the rules that really apply to what the relender does are specifically in place. So I'm going to walk you very quickly through all of the slides that deal with how the relender does its work. It's not going to apply to you if you are not thinking about being a relender. it's going to apply to you. So just basically you can understand how the money is getting from point A to point B so that you can then apply for it from the relender. So, but bottom line is the day-to-day oversight of the ultimate borrower is going to be done by the intermediary relender, not by FSA itself. So there's not a minimum number of acres that must be consolidated with a highly fractionated loan program. They can choose under the new rules up to 2 relenders per year. So they could decide to put all of that $10 million in those annual appropriations into one relender, or they could split it up. Funds in this program have to be used for the consolidation of ag land. It's all about agriculture. We're not at some other department. We're in the ag department. So agricultural purposes reign supreme in this circumstance. The funds can be used for the purchase of highly fractionated land, and they can also be used for the related expenses for actually getting your loan in place. Some of the loan situations are going to be you're going to have some level of environmental compliance, but again, that's going to differ loan by loan, land base by land base, and you're going to need to work closely with the relender to actually understand what their requirements are for you to be putting in place in terms of environmental compliance, if at all. But again, that's going to be very specific to the land that you're trying to unfractionalize or consolidate. Tribes, individual tribal members, and tribal entities, like tribal businesses, are eligible to apply for loans from the relender. The FSA loan itself of the $10 million is to the relender. The relender then turns around and does loans to those who are eligible, which are tribes, tribal entities, and individual tribal members. Highly fractionated lands are going to be defined in this particular program as undivided interests held by 4 or more individuals. This is going to be much under what some of our fractionated lands are at in terms of levels of fractionation. But at the same time, it also makes sure that we don't put the cutoff of how many undivided owners there are so high that you don't allow lands that are less fractionated to actually participate. So it really allows for a larger window, I guess is a good way to refer to it, of those folks who have these undivided interests, fractionated lands, to participate in the program. Agricultural use can be pretty broad. It can be products of tree farming, products of other plant and animal production. It can be all sorts of things. This next slide talks about what an agricultural commodity means. It's livestock, grains, cotton, oilseeds, dry beans, you name it, tobacco, peanuts, sugar beets, sugarcane, fruits, vegetables, forage, nursery crops, nuts, aquaculture species, products resulting from livestock, tree farming, and other plant or animal production as determined by a farm service agency. So you can see this agricultural purpose for the highly fractionated land loan itself is fairly broad. So your purpose is you're trying to get loan money to actually buy out interest, consolidate the land for an agricultural purpose. So again, be prepared when you actually go in for these loans to have your purpose in mind. You can't just hold it just for future purposes. You've got to be doing some sort of agricultural production related to it, but it's not very restrictive. You can really get a pretty broad agricultural focus going on your land. The rate of interest for the relender is going to be set annually, but it's not going to be less than 1%. And the maximum of a highly fractionated loan term is going to be 30 years. So we're looking at things that are very flexible in terms of length of the term of the loan to the relender. And then those terms of the loans to the borrower, to the ultimate borrower who's trying to consolidate land, those really are going to be how your relender deals with you on these issues in terms of negotiating interest and negotiating the term of the loan is literally going to be something that is controlled by the intermediary relending agreement that is approved by FSA, but it's a wide swath of potential circumstances. So you need to be prepared as a borrower when you go into this relender to have a really strong business plan, know what the normal interest rates are, know what your term is that you're seeking your loan for. Just because you can go up to 30 years doesn't mean you need to. Just because the interest rate could be very low for you doesn't mean that it is going to be. You may be a poor credit risk for some reason, your credit history or something along those lines. So that is impossible for us, either HL or myself, to actually determine as an absolute for purposes of this webinar. Those things literally differ applicant by applicant. But if you're the borrower, you're going to end up dealing with the relender on this, which I identified in a previous slide. This revolving loan fund slide really, it gives you a sense of how the money's moved, but it really isn't going to apply to an individual borrower. But I always believe if I'm going to be borrowing money from the federal government or even a relender to the federal government, I like to see how the money moves so that I am fully aware of how these programs work. So unless you're the relender or trying to be a relender in the future, this slide is going to be of limited interest to you. As is going to be the security for loans to the relender. But the relender itself has some very specific requirements that it has to meet in order to have that $10 million moved to it to relend to you. So again, I've thrown in some slides that deal with some other definitions that are found in the law and in the regulations. This one identifies what Indian country land, communities, and allotments are meant to be. I'll leave you to read that yourself. It's standard definitions that we're very familiar with in Indian country. If you have questions about whether your particular land falls within these, you've really got to reach out to us separately. We'll help as much as we can, but it may be something that you need to deal with your particular tribe. If there's quirks in your particular situation that cause you to question whether you fall under this definition. Again, this slide pertains to the eligibility of the intermediary relender. And so these are the types of entities described in this slide about who can actually apply to hold this $10 million and then relend it to you. So I'll let you read that yourself, but basically they are private or tribal operated nonprofits, public agencies, Indian tribes or tribal corporations, or lenders who are subject to some sort of credit examination and supervision by a state or federal regulatory agency to do lending. So again, here are some additional requirements that apply just to the relender. They have to have the legal authority to carry out the loan and have a record of some sort of successful lending in Indian country. And then they've got to have adequate assurance that the repayment of that $10 million loan, which comes to then to relend to you, is going to be repaid. The entity that has received, as of December 6, 2016, the notification that they are the first relender has already jumped through all of these hoops that are contained in this particular slide and the two or three slides previous. I'll leave you to read that in your spare time. But you can't just walk in off the street, basically, and become a relender. You have some requirements you have to meet as an entity to be able to take those appropriated dollars and then relend them to you. So when we talk about ultimate recipient, that is the borrower at the grassroots level who is trying to get the loan to consolidate the highly fractionated land. So this couple of slides really apply specifically to you. The ultimate borrower can be a Native American tribe, a tribal entity, or a member of either that receives a loan from the intermediary relender. And to receive it, you've got to comply with highly erodible land conservation and wetland conservation requirements on all their land. The reason why I underlined that, I didn't know I was going to get a question about wetlands in this particular webinar, but those kinds of issues do come up. And so it is important that you know what your wetland conservation requirements are and know that whether your land is highly erodible land, because the conditions for actually getting a loan in this program require you to comply with those requirements. You've got to agree to continue to use the land for ag purposes during the term of the loan. So if it's a 10-year loan to reduce the fractionation, then you've got to agree to have agricultural purposes for that 10-year period of time. Of course, you can pay it off early and release yourself from that, but during the term of the loan, ag purposes have to be foremost. You got to comply with all the requirements that the intermediary lender needs you to, but the funds that you receive under the loan can be used to pay costs incidental to acquiring the land, like title clearing, legal services, archaeological or land surveys, loan closing costs, etc. But again, if you're thinking about taking advantage of this, you need to sit down with the organization that just was identified in December as the recipient of this first relender status. And they'll walk you through the requirements that they are going to have of you. It's just too early for us to incorporate those in this particular webinar. You can also use them, the proceeds to pay the appraisal cost related to the loan itself. And you've got to be able to purchase fractionated interests that result in at least 51% ownership. I think this slide literally goes deeper into the actual language of what I just walked you through about the purposes of the loan and the different sorts of related costs that happen when you're acquiring land. So again, the ag purposes, the cost incidental to acquiring land, those are allowable under this particular. You can use the loan proceeds for those kinds of purposes. The loan funds cannot be used for any land improvement or development purposes, acquisition or repair of buildings or personal property, payment of operating costs, payment of finder's fees, or similar costs. Basically, it's got to be used to acquire the land. Any other things that you might want to do to the land to get it in an ag purpose, better situated for an ag purpose, are going to have to come likely from another source. But again, you need to be talking with the relender about these issues. You've got to take a look at the market value. You're not allowed to use the loan funds to acquire land that's that the cost of is in excess of the current market value. So having that appraisal, knowing what the market value is of the land is terribly important, because you've got to be in a place where you're not paying more for it than it's worth under an appraisal. Loan documentation requirements, again, get with that relender. If you are interested in participating in this, they're going to walk you through the forms they need. They're going to walk you through the loan documentation requirements, any fees or charges that might be applicable to them extending the loan to you. Again, it's too early for those to be revealed in this particular webinar, but I urge you to get with them. This slide deals with rates and terms, both to the intermediary as well as to the borrower. Again, I think I've already covered those in terms of length of term. Can't I say 30 years? Can be not less than 1% interest rate. But a lot of those things are going to turn on the type of land and what your business plan says and what your appraisal values are, and some things that are covered in previous slides. But other than that, it works just as exactly as any other land loan. That relender is going to be looking at, can you repay it? So you're going to have to be identifying within your business plan how you're going to repay that loan. Security can be quite broad in terms of security for the loan. Again, I think you're in a situation where that is an individual sort of circumstance. And it very much depends on the size of the loan, your credit worthiness. Is there any sort of proceeds from some other income that can be used as security for the loan? Those types of things are almost impossible to determine, as this rule applies in all circumstances. It so much depends on who goes in for the loan, what their situation is, what they're trying to get the money for, what the appraisal value is, and just a whole array of other issues. That's why it's so important, and I'm sure HL covered that as well, that regardless of how good you are at this, you have to go through the process of doing your own business plan that can actually really provide you the good talking points when you go in and fill out the loan applications for these loans. So December 6th, that announcement of the relending institution was done. The first recipient is that entity in Browning, Montana, Native American Community Development Corporation Financial Services. And so very excited that they were awarded that. If Congress continues to put appropriated money into this program, then I'm sure FSA will have additional requests for applications for new relenders or for re-upping this relender. It really is very important to keep your eye out on that. You may know of a good relender in your area that you should encourage to become a relender in this program. But again, we'll just have to wait and see how that rolls out under the new administration and see what's next out of this coming Congress and any future appropriations. So I just threw this last slide in, and 2015 is the most recent funding accomplishments that Farm Service Agency has made public. I don't think 2016 is out because it just was over. But these kinds of numbers are very exciting for me to see because I've been friends and colleagues with Farm Service Agency folks for a long time, and to see this level of commitment that touches on folks all over Indian country is very exciting to me. So I'll leave that so that you can kind of see how much money FSA is actually moving into our communities in billions of dollars in both beginning farmer levels, historically underserved, and women farmers and ranchers, both in ownership and operation, direct and guaranteed loans. These kinds of things we don't think about them very often, but it is important to kind of see the numbers ever so often so that you can get a sense of how we fit into this. So there's my contact information, and there's HL's again. As we've said previously, just holler at us. Send us an email. Check out our website if you want to go over this again. And if there's any questions, I will take them right now. And otherwise, we'll talk to you next webinar, which will be appeal rights.
Yeah, next Tuesday. Thank you, Janie. Just wanted to remind everyone that if you have a question about this presentation, you can go to your control panel and raise your hand, or you can type a question into the questions box and I will read it out loud. While you're doing that, just a reminder, as Janie said, please visit our website that you see at the bottom of the screen, indigenousfoodandag.com/FSA. If you go to that webpage, you'll be able to see videos of all the previous webinars we've done in this series. And I will probably have this webinar loaded to that webpage by the end of the day tomorrow. And then you can also register for the one remaining that we have in this series, which is your application rights. And that will be next Tuesday. I'm not seeing any questions. So Janie, any final thoughts?
No, just other than that, we want to thank you for joining us today, but we also want to thank our colleagues at Farm Service Agency for partnering with us on this. Very important to get these kinds of details out to folks frequently, and we appreciate their support and helping to make that happen. So give us a holler anytime if you got questions about these. The programs that I talked about or the ones that HL talked about, or really anything that's in any of our webinar series. We remain ready and available to answer your questions. And good luck.
All right, and thank you again to our presenters today, Dr. Goodwin and Janie Hipp. We'll see you next time. Thank you.